This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Be fearful when others are greedy. Be greedy when others are fearful. Warren Buffett. Hello, fellow investors. Welcome to another episode of Value Investing. From this episode on, I decided to include a quote from one of the value investors out there. And in this episode, I included a quote from Warren Buffett. So he said that be fearful when others are greedy, which means when stock market is very high, just be fearful when people are jumping on the bandwagon and trying to buy stocks. And be greedy when others are fearful. From time to time, we see markets crash, and whenever that happens, people become very, very fearful of investing their money in the stock market. So you have to be greedy when that happens. So that's timeless advice that we always have to keep in mind. And this is not about how smart you are. It's more about what kind of temperament you have when it comes to investing. So in the last episode, we talked about fun facts with respect to Warren Buffett. I hope that you enjoyed those stories that I laid out there. And in this episode, what I'm going to do is go over the details in regard to economic mode. So what is economic mode? Economic mode is something that prevents companies from getting attacked by competitors. So let me just give you a quick example what this economic mode is and why it is important. Let's say you open a restaurant in your neighborhood. Let's say you sell steak to people coming to your restaurant. And you're probably going to make a lot of money if you're the only restaurant in the town. But when others see you're making a lot of profits and money, they will try to come in and open another restaurant right next to you. And your profits and sales will go down accordingly, and you might go out of business if things go bad. However, if you have some secret sauce that can prevent your restaurant from being attacked by these competitors, then your restaurant might not go out of business. If you don't have any differentiated products or services, then competitors will attack your profit margin and will take away your market share. But if you have something that can protect your business from competitors, then your business probably gonna prosper for a long time. So that's what it is called economic mode. Warren Buffett's philosophy is to buy an outstanding company with strong economic mode, also known as durable competitive advantage, run by the able and honest management, and you purchase that business at a price below intrinsic value. So there's a lot of components into this philosophy, but what I want to focus on in today's episode is economic mode. I hope that you're going to get something out of this episode and enjoy the episode. So I'm so excited to talk about this topic, but before we do that, I just want to give you a quick disclaimer that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? As I mentioned in the intro, it is important and crucial for you to understand economic mode whenever you're trying to buy a stock from the stock market. And I told you why it is important. You can make tons of money and your profit and your returns will be high if you invest your money in a stock that can be protected by this economic mode. And if you're thinking about putting your money in the stock market for the long term, you'd be better off if you buy companies with strong economic mode. That makes perfect sense. However, if your investment strategy is more like Ben Graham approach, which is you're buying a stock at cheap price and selling the stock when that stock price goes up to intrinsic value, then probably this is not something that you want to look at, because the only objective that you have from that approach is buying companies at cheap price regardless of how good the business model is. However, if your objective is to buy outstanding companies and put your money in the long term, so it's a buy and hold strategy for more than 10 years, then you're gonna be better off, definitely better off, if you buy a company with a strong economic moat. So I told you one example, how you can interpret this economic moat by mentioning steakhouse example, right? Opening steakhouse in your town. There are 5 different types of economic moat that you can find from various companies. So let's just go over each type, and I'm going to also provide an example from the stock market, what company has such trait. First, economic moat could arise from brand recognition. Look at what happened to Apple. Apple first came out with these smartphones, and Steve Jobs had brilliant marketing tactic when he first introduced smartphones to the market. And it just created millions of customers who became loyal to Apple brand. And that's how Apple could charge very high price to their customers, because their customers do not care about price. Their customers care more about this Apple brand and the quality of product, and that's how Apple was able to charge very high price. And if you look at Apple smartphones, these days I think Apple came out with a new version of iPhone, and they're charging more than $1,000 per smartphone. So that's quite a significant amount if you compare that against competitors' smartphones, because competitors can probably charge 1/5 of that amount and still struggling to increase their market share. So in that sense, Apple is a great company because Apple can charge very high price to its customers, which translate into very high profit margin for the company. And I believe that's why Warren Buffett purchased a lot of shares of Apple for his portfolio. The second type that I want to mention here is network effect. And the company that I can think of off the top of my head is Facebook. Because Facebook has billions of users on its platform, it just has a huge economic moat. Let's say you have billions of dollars and somebody give you billions of dollars and create another Facebook. You can do it. You can hire developers and you can create this platform online and also iPhone and Android phone and so on. However, the problem is all these users are already on Facebook and they have a lot of connections and pictures and videos. Everything is on Facebook. So it's not likely that they're going to move on to this new platform that you created with billions of dollars. So you're not going to be able to take away market share from Facebook. So that's why I believe that Facebook has huge economic moat because of network effect. The network effect also exists in other companies like Uber and Lyft. So if you look at these two companies have a lot of riders and also a lot of drivers on their platform. So if you're trying to create a similar platform, you're going to have a hard time because you just don't have this many people on your platform to begin with. Because of this network effect, I believe that Uber and Lyft will prosper in the future, and not sure if their valuation is high or low, but in terms of business model, they have good business model. What about Visa and MasterCard? I think they have also huge payment network around the world. And it's just not easy for a startup to have this huge payment network around the world. So it's not just easy for competitors to come in and take away market share. So if company has a business model that is based on network effect, and if the company has already accumulated certain number of users on this platform, then the company can prosper in the future and make profits off of their platform. The third type of economic moat that I want to discuss here is enterprises with a business model where customers will have high switching cost if they're trying to move to different competitors. So think about, let's say, Verizon Internet. Because I signed up for Verizon Internet, I'm not going to sign up for another internet provider unless they provide significant benefit to me. But if you look at Comcast and Verizon, they're pretty much the same. Their pricing is pretty much the same, and internet speed probably is going to be similar. So once I sign up for one internet provider, I wouldn't even bother to go to competitors unless they provide significant benefit to me. Because if you think about it, I'm a busy person. And if I want to switch to Comcast, for example, I have to call Verizon saying that I'm going to cancel the service and probably I'm going to pay some penalty fee in order to cancel the service, right? That's number one. And number two, I have to call Verizon and try to schedule an appointment so that technician can come into my house and install the internet. And there's going to be time in between where I might not be able to use my internet, which is crucial service that I need for various activities. It's just too much hassle for me. So unless there's a significant benefit that I get from Comcast, I'm not going to switch my internet. So there's a high switching cost for internet providers. And same thing goes for checking accounts, because I'm using JP Morgan Chase checking account, and I'm not going to change my checking account unless I get significant benefit from moving this checking account to another bank. If they say that they're going to provide additional 0.5% interest on whatever money that I have in my checking account, then I'm not going to move because it's just too much hassle. So there's a different degree of switching cost. I would say that internet provider switching cost is a lot higher than the one in the case of checking account. But as long as the business has high switching cost for its customers, their customers will be sticky to whatever products and services that this business provides. Which means it's good for the investors for those companies because business can have constant stream of income coming from these sticky customers. However, I'm not saying that these internet providers have great business model, because in this case, a startup can come in and disrupt the whole industry if startup has sort of technology that can connect people to the internet without going through all this network. Then it's going to be a completely different game, and these internet providers may struggle in the future. But as of this recording, I don't really see that technology happening anytime soon. So still, these internet providers have strong economic moat. The next type that I want to discuss is patents. Because a lot of companies have patents in their portfolio. And usually if you try to understand biotechnology company, then it's important for you to understand what kind of patents this company has. Because if you look at what happened to Gilead pharmaceutical company, then you'll see how significant the patent is. Because Gilead pharmaceutical company had a patent for a certain disease, and this patent expired, and sales dropped significantly along with the stock price. If you want to invest your money in a biopharmaceutical company, then you might want to look at their portfolio and see what products will have patent expire sometime in the near future. So it's kind of double-edged sword for investors. You just have to do a lot of research just to get a good understanding of what products make up the portfolio of that biotechnology company. The last type that I want to mention with respect to economic moat is low-cost operators. Look at what happened to Walmart, Costco, Amazon. These are the big retailers that can operate with very, very thin profit margin. So in the case of Walmart, a lot of mom and pop retailers had been driven out of business because Walmart came into their town and just provided a lot of products at very, very low price. So if you're not competitive in this industry, and if you're not competitive in terms of price, you're not going to survive in this industry. So I would say that this is not better business model compared to the other types that I just mentioned in this episode, because you just have to have very thin profit margin. which can be subject to other attacks if there's another low-cost operator. But if you believe that this company is definitely absolutely the best low-cost operator, like Amazon and Walmart, then you can probably give a shot in terms of investing your money because this is a huge market. If you look at commerce market, I'm not just talking about e-commerce. If you look at commerce market, this is like $1 trillion market. So even if you have very small profit margin, you can still become multi-billion dollar company. So that's kind of the beauty of operating in this market. Okay, so we talked about 5 different types. First one was the companies with brand recognition, and the second one is network effect. Third one, business model with high switching cost. Fourth, patents, and the last one is low cost operators. The reason why I mention all these different types is because I just want to facilitate your investment analysis whenever you're trying to find out outstanding company in the stock market. Once you understand what the economic mode is, then you're probably going to have a better sense in terms of how this company is going to operate in the future. And the better you understand in regard to economic mode, the more money you're probably going to make in the long term. So why don't we actually look at Warren Buffett's portfolio and see what kind of economic mode exists for the companies that he has in his portfolio. The most famous investment Warren Buffett made decades ago was CocaCola. If you look at CocaCola, this company has different types of economic mode. The first one is brand recognition, which we just discussed. Because if you look at Coca-Cola and Pepsi, I don't think that there are many people who can differentiate the taste between Coca-Cola and Pepsi. But still, majority of people go with Coca-Cola because of brand recognition. There's a big share of mind within people. I'm not talking about market share. It's about mind share within people's mind. So people really have favorable views on Coca-Cola over Pepsi that actually translate into more profits and more revenue for Coca-Cola, even if the tastes are exactly the same. Another thing that I want to mention related to Coca-Cola is the fact that Coca-Cola is not subject to law of diminishing marginal utility. It sounds fancy, but what I'm trying to say here is that the first time you drink Coca-Cola in a day, you're probably going to taste it really good. But second time and third time and fifth time, as you go along, usually other products have this diminishing utility, which means the products do not taste as good as the first time. But that's not the case for Coca-Cola. And that's what Warren Buffett mentioned in one of his interviews in the past. The fifth can of Coca-Cola is going to be just as good as the first can of Coca-Cola that you drink in a day. So there's no diminishing marginal utility. That's a huge benefit for Coca-Cola company. And that actually leads to customers drinking tons of Coca-Cola a day. Probably it's not good for their health, but they still do it because they got into the habit of doing it. And that's what Warren Buffett does. And he loves it. So Warren Buffett has other companies like American Express and Wells Fargo, and these are the companies that Warren Buffett has held for more than decades. And all of these companies have some sort of economic mode. And what's also important and that I want to emphasize is that economic mode is not a static concept. It's not something that you just have at a given point in time. It's something that evolves over time. So in some cases, you're going to see economic mode getting strengthened over time. Some cases, you're going to see economic mode get weakened over time. So it's important for you to understand how the trends are heading for various businesses and try to catch the ones with strengthening economic mode. Okay, so we discussed a lot of things in regard to economic mode today. I hope that this episode was helpful. So The bottom line here that I want to emphasize is that not only it is important for you to understand statistical measures such as P ratio and price to book ratio and so on, and discounted cash flow analysis, that's what a lot of people seem to focus on. You also need to put a lot of attention and energy into qualitative factors like economic moat. If you don't have that calculation right, then you're going to lose a lot of money if you put the money in the long term. But as a value investor, I like to always think about myself as a long-term investor, and whenever I try to buy a stock, then I want to put at least for the next 3 years. So if I want my investment to be successful over the next 3 years, the most important part is not actually quantitative parts. Quantitative parts are important, but what's equally important and what's probably more important is qualitative factors like economic moat. So that's something that I wanted to emphasize in this episode, and hopefully you get what I'm trying to say. Maybe you have some differing views, but that's just my personal opinions. And that's going to give you upper hand over quantitative traders who are just trading the stocks based on quantitative and statistical metrics. And you want to have some advantage and upper hand in this game, otherwise you're not going to be able to beat the market, which is very, very hard, and you're not going to enjoy the process. So thank you very much. I hope you enjoyed this episode. And before I end, I just want to remind you that please leave your reviews, comments on iTunes and whatever platform that you listen to this podcast. And as I mentioned before, I'm in the process of developing my website, and I'm just gonna get it up and running very soon. So I'll let you know once it's up and running. Thank you very much, and see you next time.